Good morning, everyone, and welcome to our DAT IQ weekly market update. This is our update for October 25th, 2022. I'm Ken Adamo, Chief of Analytics here at DAT, live on site from our Denver office, and I'm joined, as always, by the illustrious Dean Croak, who's our Principal Industry Analyst. Good morning, Dean.
Good morning, Ken. Good to be here again.
Yeah, it's a great day. It's been a beautiful morning here in Denver. I was able to take advantage of some time zone arbitrage and watch the sunrise from our office cafeteria out here. It's been great. How are things out your way?
Fall's in full swing over here. We've got a lot of tourists, a lot of charter buses, a lot of leaf peepers. Colours are very vibrant this year because of the drought. Dry conditions have made the colours very vibrant. So it's just a spectacular time of the year. I'm always amazed, having lived in a country with one season most of my life and no weather channel, that we have 4 seasons here that are very distinct, and it changes literally on a weekend. It's just still fascinating to watch after 22 years of being here.
Yeah, I think in Ohio we have 17 seasons, but that's just sort of what you learn to live with.
Yeah, right.
All right, let's get right into it. Be sure to get your questions in the chat, so we'll have time to answer those towards the end. But I'm going to get right into our key points of the week. So rising fuel prices is unfortunately putting some downward pressure on spot rates, sort of squashing that little rally we had been seeing heading into the peak shipping season. Contract rates are showing some strength, actually. So they are down, as you would expect as part in the cycle, but we're seeing some resistance to edging as low as we might expect given spot rates. Hurricane Ian's fruit and veg damage estimate up to $1 billion. That's a lot of fruit and vegetables. And then some industry metrics to make you aware of. September ATA truck tonnage was up 5.5% year over year. That's the highest value since August 2019. Manufacturing activity up 4.6% in September. That's 58% of TL ton miles, according to Michigan State and Jason Miller up there. And then the first true winter storm of the season closed I-80 in Utah over the weekend. I'm going to turn it over to Dean for our market update. Dean?
Yeah, thanks, Ken. It was interesting to watch some of the social media goings on over the weekend with I-80 shutting down. The big takeaway was drivers were totally unprepared, as is always the case in the early part of winter. So let's dive into the market update. Let's start with the load-to-truck ratio in the dry van sector. Somewhat unusual, a little bit unseasonal. Load post plunged last week, the third week of October. They don't normally do that by as much, down 16%. Last week, compared to mid-October last year, load post volumes are now about 41% lower. Equipment posts, on the other hand, are about 22% higher year over year. Spot market capacity in dry van continues to loosen as measured by equipment posts. They're up 13% in the last month. And compared to 2019, when the market was oversupplied with trucks, last week's equipment post volumes were about 8% higher. So as a result of fewer load posts and more equipment posts last week, the dry van load to truck ratio decreased to 2.47. And as you can see from the chart, not far off 2018 and 2019 levels. In the refrigerated sector, load posts are very close to 2018 and 2019 levels, following last week's 26% week over week decrease. Capacity, like dry van, continues to loosen. Last week, equipment posts were up 6%, up 9% in the last month. And now, as you can see from the chart, they're about 6% lower than the record high set in March 20 as freight demand crashed at the start of the pandemic. So it's driving down the load-to-truck ratio to 2018, 2019 levels at about 3.97 last week. Flatbed load posts decreased 8% last week. They're about 61% lower than the previous year. And like dry van and reefer trailers, they're almost identical to late 2018 and 2019 load post levels when capacity began to loosen following the flatbed rate rally in early 2018. Capacity remained flat last week and has been that way for most of the month. In terms of equipment posts, still at very high levels for this time of the year. In fact, the highest level in the last 6 years in terms of carriers looking for loads on our load board. The load posts decrease last week pushed down the load to truck ratio on flatbed to 11.64. So having a look at our market condition index, starting off in Joliet and Chicago last week, capacity tightened. They're the largest freight markets in the Midwest. Outbound loads, spot rates increased just a penny per mile to a combined average of $2.27. Chicago to Atlanta is quite a busy lane in the spot market. Capacity's been tightening since July. Spot rates up 30 cents a mile over that time frame, averaging $2.31 per mile last week. Remember, folks, these are line haul rates excluding driving fuel. This time last year, though, Chicago to Atlanta line haul rates were $1.16 per mile higher at $3.47 and peaked at a 12-month high of $3.87 in January this year, Chicago to Atlanta. And even though load posts dropped 26% in Brooklyn last week, capacity was tight. Rates up 15 cents a mile for outbound loads to an average of $2.18. That's Brooklyn, New York. And nearby Elmira, New York, capacity was tight also. Average outbound rates were up 8 cents a mile to $2.09. Short haul loads from Elmira to Buffalo up to $604 a load. That's up $65 above the September average, but still about $80 a load lower than this time last year. In Pittsburgh, spot rates are up 2 cents a mile to $2.03. And on the 1,000 mile haul to hurricane-ravaged Lakeland, Florida, spot rates continue to climb, averaging $2.51 over the last 7 days. And even though line haul rates on this lane have increased by 56 cents a mile since May, last week average is still 87 cents a mile lower compared to this time last year. In the refrigerated sector, we'll start out in California. Outbound California reefer line haul rates at a state level were down 2% last week. Average was $2.28 for outbound loads, although capacity did tighten slightly in Stockton and San Diego markets. In Stockton, line haul rates for all outbound loads increased by 3 cents a mile to $2.20. That reversed a 3-week downward trend. In contrast, capacity loosened on the high volume lane south to Ontario from Stockton, where line haul rates averaged $2.22 per mile last week. That's about 50 cents per mile lower than the September average and $1.45 a mile lower than this time last year. Another busy lane for reefer carriers is Stockton to Los Angeles. Rates were 30 cents a mile higher last week at $2.51 and also lower by almost the same amount as the previous years. In Texas, capacity was tight last week for refrigerated carriers. Rates are up to $2.14 a mile, about a 2% week-over-week increase. Even though it's one of the smallest markets in the Southwest, capacity tightened the most in San Antonio. Rates are up 9 cents a mile to $1.94. And in the largest market in the state, Dallas, outbound spot rates increased about a penny per mile to $1.95 for outbound reefer loads. While in the border market in Laredo, capacity loosened this week. It's about 3 weeks in a row it's been doing that. Rates were down 2 cents a mile to an average of $2.09. That's outbound Laredo spot rates. And on the East Coast in Lakeland, Florida, of course, where Hurricane Ian made landfall, capacity tightened slightly last week. For refrigerated carriers, rates are up a penny per mile to $1.17. That's 117. And in the high volume lane, inbound from Atlanta to Lakeland, where a lot of supplies have been coming in, spot rates dropped under $3 a mile for the first time since May. At $2.96, spot rates on this lane are $1.40 per mile lower than this time last year. Having a look at our flatbed sector, capacity tightened in Arizona last week, 8% increase in line haul rates to $1.37. In Nogales, Arizona, that's a very busy cross-border market. Out west, flatbed capacity was tight. Rates increased from by 9 cents a mile to $1.48, and that reversed a 3-week slide. Most outbound lanes from Nogales reported lower spot rates last week, except for loads 470 miles north to Las Vegas. Line haul rates on that lane spiked last week and at $2.31 a mile, or about 74 cents a mile higher than the September average, and 48 cents a mile higher than this time last year. So lots of volume moving on the Nogales to Las Vegas lane. Nogales is the largest commercial zone for trucks crossing. It's the 4th largest along the southern border. Lots of activity there expected throughout the rest of the year for both reefer and flatbed carriers. In Grand Rapids this week, having a look up in the Midwest, flatbed capacity was tight last week. Spot rates increased by almost 30 cents a mile to $2.84. That's after declining for the prior 2 weeks. And after dropping to by $1.48 since January, line haul rates from Grand Rapids to Wilmington, North Carolina, reverse course last week, increasing to $1.88 per mile. Capacity was flat, though, at $2.51 for short haul loads east to Madison from Grand Rapids. On the West Coast, flatbed capacity was generally tight. Reno, Nevada, market reported a 7 cents per mile week-over-week gain to an average of $2.21 for outbound loads in Reno. Further north in the very large Portland, Oregon market in the Pacific Northwest, rates increased 4 cents a mile to $2.36, following a 38% week-over-week increase in load posts. And wrapping up with our year-over-year look at spot rates, Dry van spot rates have decreased by just over $1 per mile, or about 36% since the start of this year. Rates were down 4 cents a mile last week to an national average of $1.71 per mile, excluding fuel. Rates are now 72 cents a mile lower compared to this time last year. And as you can see from the chart, about 3 cents per mile lower than 2018, just 2 cents a mile higher than 2017, which of course was a recovery year following the 2016 freight recession. Having a look at refrigerated, the USDA did not report a shortage of trucks in any of the 16 produce growing regions last week. That's the first time this year they haven't reported a shortage in any of the produce regions. It's quite a significant data point. In contrast, last year, there was a shortage of refrigerated trucks in 17 of the 20 produce growing regions. Last week's national average reefer spot rate decreased by 4 cents a mile to a national average of 207. Compared to last year, reefer rates are about 82 cents per mile lower and about 2 cents per mile lower than 2018. And in flatbed, line haul spot rates have dropped 12 cents a mile in the previous 2 weeks, following last week's 5 cents per mile decrease. National flat rates averaged 209 last week. That's just over 54 cents a mile lower than this time last year, 13 cents per mile lower than this time in 2018, and just 3 cents a mile higher than 2017. Flatbed spot rates have decreased around 58 cents a mile since the start of the year, but 56 cents a mile of that has occurred since June the 1st. And that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly report. And with that, it's over to Ken for the short-term forecast.
All right. Thanks, Dean. So let's talk about the dry van forecast first. So just to reiterate, for those less familiar with this chart, the blue line is the historical rates over time, dating back from June 1st. So this is a weighted 7-day moving average, excluding fuel, for a long-haul dry van. The green line is RateCast, which is our flagship model. You'll find it in a lot of our rating products. The red line is a short-term forecast, which would more heavily weights more recent data. And then the gray and the yellow are blends of the two. So what you can see here is RateCast being the lone member of disagreement. A little bit more optimistic heading into peak and Thanksgiving and Black Friday. The other three pretty much in agreement of a slow kind of descent down to $1.70. Really, this is being driven by impacts of the fuel price increase. If you look back to the start of October, we had that little bit of a rally going on, and then the floor sort of fell out based on fuel going up 50 or so cents a mile. So quite unfortunate. Let's move to reefer. Again, they weren't seeing quite as much of a rally, but same relative impact due to fuel. There's a little bit more disagreement. I think it's kind of interesting here that the blended models are below either of the two primary models here. I think that's showing some inherent pessimism amongst the modeling ensemble. But again, sort of bottoming out around $2 a mile heading into Black Friday. And then flatbed, again, you're seeing three models in agreement over the next 35 days, and then RateCast being slightly more optimistic. So with that, we are going to move over to our question of the week. Dean?
Yeah, the question of this week is very topical. It's just 31 days away from today until Black Friday. And the question of the week is, what are the hottest markets for e-commerce shipping as we gear up for Black Friday sales and shopping?
So I understand you and your team, Dean, did quite a bit of analysis around this.
Yeah, interesting data points. Christina Ellington on our data science research team did some wonderful analytics yesterday. We took a look at all of the large warehouse markets across the country. Some of those locations are like in California, Florida, Georgia, Illinois, Columbus, Ohio, a lot of warehouses on I-78 around Allentown, Harrisburg, Carlisle, those sorts of markets. So we dug into the outbound rates on all of those lanes and some of the volumes. A lot of downward pressure on spot rates, though, not a lot of upward movement on those lanes just yet. our general consensus is that some of the hottest markets will be large population centres, because e-commerce ships direct to store, or that sort of secondary warehouse close to fulfillment centres. So some of the big markets, I think, this year will be where we see some of our big box retailers in particular. So there'll be a lot of the big states, including Pennsylvania, Florida, Illinois, Texas, California, where we're expecting to see some pretty significant volumes. One of the interesting data points, Ken, was that some of the data points we're seeing on the contract side of our business, a lot of inbound volume into the state of Pennsylvania, which again is consistent with what we've been seeing in our business for the last couple of years during the pandemic, when we've seen a lot of retail freight fulfilled, stored, staged closer to big population centres. And when you look at I-78 around Allentown, there's 100 million people within a 500-mile radius of Allentown. So if you were going to set up a distribution centre in e-commerce to get retail freight out in a hurry for, things like Amazon Prime Day that we just had, the second one this year, some of the big sales that are coming up ahead of Thanksgiving, it's an ideal place. And I know over the last couple of years, I've ordered a lot of things online, and a lot of that overnight freight that comes in when I get my Amazon order, for example, the next day, comes in from the Allentown, Pennsylvania area. It comes in overnight. I think it's about 300 miles. It's a tough night for carriers, but a lot of it hits the distribution centres early in the morning, and then it's on a P&D truck for the rest of the day. So I think big population centres, Ken, I suspect a lot of the freight's already moved into these overflowing warehouses already. So my guess would be there'll be a lot of short haul movement of freight heading into Black Friday from a lot of those warehouse markets that are very close to big populations, would be our general consensus.
I was really surprised, Dean, with the Pennsylvania. I mean, we know that Harrisburg and that area is a big e-commerce area, but there's a lot of congestion. I mean, that's kind of like a freight nightmare, that whole Northeast Pennsylvania, New Jersey, New York corridor. That's tough, right?
It's a brutal lane to run, whether you're running 95 or out across 84. It's a tough area to run because it's always congested through those areas. That's why a lot of guys run it overnight. It's 300 miles. It's a really hard night when you get out late in the evening to be up here first thing in the morning. And then run back, turn around and run straight back. It's a tough day, but I know a lot of guys do it. It's and it pays reasonably well, but traffic is, of course, the big problem, and that gets harder and harder as we get further into winter. I think it'll be okay leading into the holiday period. Our winters tend to come much later up in New England now. It's more so in January before we see some of the snowfalls that are significant. We haven't seen snow here in New England before Thanksgiving, I think, in a couple of years now.
Yeah, I mean, it snowed already in Ohio, so we've already had like 7 of our 15 seasons. None of it's stuck, though. I think kind of to put a bow on this, again, short of like people being bored and writing about whether this is going to be a peak or not, I don't know that that's kind of all that important to litigate, right? I mean, if you're involved in the retail or wholesale space, sure, you might see diminished activity based on some elevated inventories in certain sectors, but it certainly is busier than other times of the year, and I think it'll certainly remain busy heading into the fall. Wouldn't you kind of agree with that assessment?
Oh, absolutely. Yeah, I think it's just going to be very busy for short haul carriers in particular.
I think so too.
Those regional moves. There's still a lot of, as Jason Miller reported today, there's still a lot of activity going on in the manufacturing sector, even though, there's lots of talk of doom and gloom in the housing market. Housing construction levels are still at 2018, 2019 levels. So there's still plenty of freight moving, a lot of building and construction materials moving. There's a lot of infrastructure projects underway, lots of freight still moving. So there'll still be a consistent amount of volume. I know a lot of carriers are very busy. They're certainly not very pessimistic about what things are doing, but as they always do this time of the year, they look for other opportunities when things quieten down in certain sectors. So you'll see guys swap trailers, and I know a lot of guys here that will drop dry vans that they've been pulling regionally and jump under gasoline tankers, heating oil and things like that.
Yeah, I think one, and again, I don't want to spend, we have some questions coming in. I don't want to spend too much time here. I think we should go back and look at length of haul because I think it's an interesting thing, right? As we saw, when we were at DATCon, we were talking to a lot of the shippers. They said, you might see there's so many metrics out there, right? So if you look at tonnage, that's a different metric than shipments. And really,
Right.
a perfect metric would be able to give you shipments and load factor, because what a lot of the shippers told us is they may have reduced their shipment count by not being as stretched as thin, and they're able to wait and maybe hold an extra day to increase the load factor on those trailers. And that's something we don't have a great visibility into, but we do have really good visibility in the length of haul. And I'm curious in those key markets how length of haul has shifted recently, and if kind of the easing of capacity back to pre-pandemic levels has impacted that length of haul at all. That's something we should take a look into.
Yeah, absolutely. All right, so we'll dive into some questions.
Yeah.
All right.
Alexander Escobar writes, why does the fuel surcharge not transfer to the spot market? Are shippers still being charged the fuel surcharge but not transferred to the carrier? Or if the fuel charge is not charged to the shipper, why would the shippers not opt for a much less expensive spot market in markets that are somewhat loose? It's a wonderful question. You want to take a swag at it first, Dean?
No, you go first. I'm curious to see what your take is on this.
So I think in spot transactions, let me level set what I mean by that. So in a transaction where the broker is dealing with the carrier, with the shipper on the spot market, and on the spot market with the carrier, oftentimes the fuel is sort of just negotiated all in on both sides. There are exceptions, right? So if you're like a backup carrier as a broker, you might have an established rules tariff and fuel surcharge with that shipper, where if you get the freight, the fuel surcharge is automatic. I don't know how that's split. I can't jog my memory from my time in industry, but I have to imagine it's a minority of the case.
Right.
Now, what we do know is that brokers have won a lot more contract freight, and that will absolutely have a fuel surcharge in place. Very rarely is there a fuel surcharge in place on the carrier side, regardless. So that's just negotiated all in. So if you're a carrier, the best advice I can give you is to be very well aware of your operating expenses. DAT publishes a fuel surcharge with no expense that you can go on our website and check out. It's updated every time fuel updates. And as you're thinking about your operating costs, maybe that's something you bake into the negotiations, because to your point, it's not going to be a default value. So I think that's a comprehensive answer, Dean, but what do you think?
Yeah, I generally agree. I think the broader question relates to the applicability of it. The fuel surcharge is really there to handle the long-term fluctuations in the contract freight market, which is most of the freight. The day of daily transactions in the spot market, it's very hard to factor in the longer-term fluctuations in fuel prices. So the spot market tends to be an all-in rate. That's why it's absolutely critical in the spot market. You know what your operating costs are, because if you're not setting your rates, someone else is. And you've got to know your operating costs. You've got to know that diesel is 52 cents a mile, what percentage of operating cost it is. You've got to know what your MPG is. So it's very important that carriers in the spot market know what the fuel surcharge component is, so they can negotiate a reasonable rate in that market. So really it comes down to the fuel surcharge was implemented, I think, way back in the 80s, I think it was, Ken. Maybe I've got the date wrong, but it certainly followed that 1973 oil crisis that we had, and the wild fluctuations in diesel prices that carriers were subject to way back then.
Yeah, I'll add the last part of Alexander's question. I think it's more of a fallacy that shippers sit there and kind of on a shipment by shipment basis dynamically choose the spot market versus the contract market. I mean, I think in most cases, there are exceptions to every rule. I'm not speaking in absolutes, but I think in most cases, what you're seeing right now is just enhanced routing guide compliance. They want the service. They maybe have had a shorter rebid cycle, so they're not getting totally penalized on the contract market. So where it may be attractive to tap into the spot market, they're pleased with the service they're getting. They're keeping their contract carriers busy.
Right. And
they might not necessarily have the time or the appetite, or that's not in their strategic intent to kind of dynamically shift to the spot market. So I think that it certainly happens, maybe more progressive or smaller shippers are doing that kind of behavior. But I think by and large, that's more of like something that's interesting to think about than actually happens in real life. At least the shippers that we talk with, right? And they're our customers. Dean, a couple ones for you. Retail home sellers are waiting for buyers longer. Are you seeing large builders slow down or permits and starts? Any unusual signals that might indicate a larger slowdown in the building industry?
Good question. Housing starts were down again in the last, so that bubble has certainly burst in terms of the big increase in building activity we saw early in the year. I'm just trying to pull up the housing starts data here quickly so we could quote some exact numbers. I'm probably not going to be able to get to it quick enough. Yes, it's definitely slowing down, but as I said at the start of the show, Ken, housing starts, single-family housing starts are at about 2018, 2019 levels. So yes, that they've slowed right down. But not to anywhere, I don't think they're at cataclysmic levels. So one of the things that the media has overplayed is how much things have dropped compared to this time last year. There's still a fair bit of activity. We're still building more homes than we did back in that big freight cycle in 2018, 2019. So we've still got pretty good volumes. We're certainly seeing a bite of interest rates. Consumer sentiment's way down. Interest rates are high. That's crimping a lot of the activity in the new home market. But of course, builders have got a lot of challenges in terms of supply chain disruption that are ongoing, not to mention labour supply issues. So we're still seeing some issues on the supply side. And but where I'm in New England, we're not seeing any movement in new home prices. We are seeing inventory stay on the market a little bit longer, and building activity is as busy as it ever was. So I think there's pockets of the country.
Interest rates are 7.5%, right? I mean, I locked in 2 years ago on a 15-year fixed rate mortgage at 2.1%.
Right,
my brother just bought a house for 7.3%.
Yep.
He's paying more per month on a 30-year than I am on a 15-year for my house is twice as expensive.
Right.
I mean, that's not like they're just starting out. I mean, that wasn't a mandate on how expensive our houses are. It's just about interest rates.
Right.
It's Ohio. They're all cheap. Trust me.
I just pulled up some numbers, Ken. Single-family housing starts are down about 14% year over year, down 4% in the last month. Permits, which are a leading indicator of flatbed demand, I think, in the building industry, they tend to lead new homes starting by 1 to 2 months. They're down about the same amount, 14% year over year. So, but we're still well above where we were back in 2018, 2019 in terms of the volume of homes being built.
All right. Dean, do you have any data on the number of new motor carrier numbers issues versus motor carrier numbers canceled? I know this is something you track pretty intensely.
Yeah, good question. I just pulled up some data from the FMCSA. The latest data we've got is August. We had new companies issued DAT authorizations in August, 8,589. We've had about a 31% increase year over year in the number of companies entering the market. They were down about 2% last month, though. But if you go back and look at the start of the year to now, they've been averaging about 9,000 new companies have been getting a DOT number all of this year. That's 9,000 per month. And we've been adding power units at a pretty good clip all year. Again, we've been adding power units at an average of about, I'm going to take a swag at this and say about 25,000 powered units per month over the course of this year also. So we're still adding capacity. We don't have the revocations that you're alluding to. I don't have a good data point on that to do sort of a plus minus on new authorities versus those that exits. That's a data point we're developing. But I would say, just a word of caution with all of those data points, DOT authorities are issued for everything from a box truck to a Sprinter van, in some cases to a Class 8 truck. So it could be a hotshot dually pulling a drop deck trailer all the way through to a big over-the-road truck. So a lot of people fall into the trap of thinking that DOT authorizations just relate to the big truck market. They don't. And I think in the last year, we've seen a disproportionate number of new DOT authorities issued to much smaller vehicles, which fits into our question of the week because we've seen a lot more deliveries being made closer to big populations in smaller vehicles. We're working hard to try and quantify what that growth has been in that smaller vehicle market. We'll be able to report on that soon.
All right, one more question. Kind of end on a broad singer. Any thoughts on the California spot rate market moving forward? It comes from Davis.
Yeah, it's all down at the moment. Not a lot of movement. Produce season's over. Retail imports are coming down. It's all negative at the moment in terms of week over week growth in that particular market. So not a lot of good news in the California spot market. in both dry van and reef. I think there's some interesting pockets of activity in flatbed, though. San Diego's always an interesting market. A lot of coil steel comes in there on break bulk. So I'd keep an eye on some of those markets. But certainly overall trend is not good in California, especially given the shift in imports to the Gulf and East Coasts. Normally you'd see a lot more activity around Los Angeles, Long Beach. That's disappeared almost this year as those ships have pushed a lot more volume to the Gulf and East Coast, Houston, Mobile, Savannah markets.
Yeah, that it's just been super interesting how you've seen like these things just sort of like this shift, and I think the pressure that puts on some of these traditional e-commerce and warehousing markets will be interesting to watch, especially for those kind of very isolated regional impacts.
Yeah.
All right, Dean, let's land this plane. Let's get some plugs in here.
All right. Okay. So let me pull up all of my call outs for the week. We've got a lot going on this week. Let's start off with I'll be on the Rates and Lanes podcast tonight with Chuck Snow and Rico Mohammed. You can catch them on YouTube. Sales chat tomorrow with Dan Deegan. Again, you can connect with them on LinkedIn. Stephen Pettit's going to be on Landline now at 7 p.m. Eastern tomorrow night on Road Dog Radio Sirius XM channel 146. On that same channel, I'll be on with Jimmy Mack on Thursday morning at 8 a.m. Don't forget the latest Freightvine podcast featuring Bill Cassidy from the Journal of Commerce. And with that, it's back to Ken to wrap up this week's show.
All right. Yeah, I want to thank everyone for joining us. I think it was a really, really good discussion. As Dean said, I would recommend checking out his long-form market update, especially as we tick through peak here. There's going to be a lot of really interesting things to check out. I would also encourage you to go to, if you're a DAT customer, go to iq.dat.com. You'll see our new landing page, which has a lot of really cool kind of at a glance data analytics and insights. You can see MCI, you can see some load and truck data and some rate data, some really cool stuff the team's working on. But with that, I'm going to go continue my day in beautiful Denver, Colorado here. I hope all of you have a really great week, and we'll see you back here next week. Bye, everyone.
Okay, bye.